In this section, we're going to talk about drawing trend lines, right? Remember, the trend is your friend, the classic quote in technical analysis, right? Because when you have trends, you have established kind of patterns just in the trend of whether it's going upwards or downwards, and we can, very strong indicator, we can really trade on that. But to do that, we need to be able to draw trend lines and be able to identify and then draw the trend lines to help us make decisions around that. And trend lines are drawn with a straight line, so you're going to be drawing some straight lines here. You don't have to be old school and draw it on a piece of paper or anything like that. Your trading platform will let you kind of draw lines and connect them and move them around and do all sorts of fun stuff. So you don't have to worry about being good with drawing straight lines. I'm not good at art, so I'm glad for the computer technology. So it's done using the trading platform. And again, trends could be an upward trend or they could be a downward trend, right? In our trend lines, there would be straight lines either indicating upward trend or downward trend. And the thing with identifying trends and using trend lines to help you really identify those trend lines and we can trade off these trend lines is it's going to give you more confidence on your buy and sell decisions, because you're now visually showing the trends and you can trade off that. And don't worry if your lines aren't perfect. I mean, they'll be nice straight lines because of the software, because of the platform, but in terms of where you place them and all that, and as you learn how to do that, that'll come with time probably pretty quickly actually. And it's not always exact. I mean, the markets go sideways, things happen, there's outliers that happen, noise, all that kind of stuff that happens that causes the price to go up or down. So again, trend lines are not always picture perfect, but they're going to be straight lines and they're going to help you with your trading decisions. So don't worry about if your trend lines are not works of art, right? And we learned about some trend lines, or some lines actually have meaning behind them already. They're like a support line, which is the lowest price in a current trading range. So it supports the price from going lower. That's a good way to remember. It supports the price from going lower, like in this triangle you see here. Or you have resistance lines where the high price it's the highest price of the current trading range. So it resists the price from going higher. It's like a line. It's a barrier. That prevents the prices from going higher as a review on that. And they are trend lines that you can draw as far as different types of trend lines you can draw. And you're trying to draw these trend lines to kind of get an idea of what is going on. And there's some questions around when you start thinking about trend lines I want to kind of get ahead of right away. And so let's look at a couple things as far as the actual drawing of the trend lines. One question is, do I need to draw in a certain place? And yes and no on that. It depends. I mean, most people will draw at the top and bottom of a candle. But you can draw in the middle of the body as well too. The whole key is to be consistent. So if you're drawing at, let's say, at the tops and bottoms, don't halfway through us and start drawing in the middle. So that's not going to be consistent. That won't be accurate for you. So either when we talk about the top or bottom of the candle, we're typically talking about at the wicks, at the upper and lower shadows at the far ends there, as you see demonstrated here, and you'll see demonstrated in the upcoming lesson. So that's how I do it. That's how most people do it. But there's nothing wrong with being consistent and going through the middle as well either. The other part of this, do I need to use candlesticks? And the answer is no. You don't have to use candlesticks. You can use any type of price bar, and sometimes something like a line bar will make it easier to see a pattern, or you're going to use another indicator overlay over the top of it, such as a moving average crossover, where your trading platform will help make it easy as far as putting all that together on it. It makes it easy to switch between price bar types too. You can usually just choose a different type of price bar. You click update or something like that, and it redraws your chart all ready to go with now price bars instead of candlesticks, or excuse me, like an open, high, low, close price bar, or maybe like a line, a trend, not trend line, but a price line, as opposed to candlesticks. So you don't have to use candlesticks. However, there's a reason people use candlesticks. I have a whole section around candlesticks. We talk a lot about candlesticks. Candlesticks are very helpful, since they can visually tell you a lot more about what's going on, like through the color of their bodies, the main body, whether it's a white or green or red, for, let's say, a downtrend, green, let's say, for an uptrend, or it might be black, whatever it might be as far as the colors in your system. Typically it's red for a downtrend, or a down day, excuse me, not downtrend, but a down day or down period. And also things like the links of their wicks can tell you something, and they have their own patterns kind of within your larger, bigger chart pattern. They'll have their own patterns too that might give you some indications on what might be happening. It might confirm what you're seeing with your overall chart pattern, or it might possibly make you rethink your overall chart pattern because something is happening with the candlesticks. So I definitely would recommend that you use candlesticks, but you can switch between the different price bars depending on what might work for you at that moment in time or what you're looking to do. For example, this image here shows an uptrend as far as, we can see it, you can see that line there. That's a trend line. It definitely has got an upward slope to it going along the bottom as far as the range indicator. So it's going along the lows of the day. But it also is, if you recognize it from like candlesticks, it's a three-soldier candlestick pattern. So you get extra confirmation. So not only is an upward trend line a good bullish sign, or the prices will rise, but also having, let's say, that three-soldier candlestick pattern, it kind of gives you even more, an idea of, okay, this looks like a very strong trend. I'm getting it confirmed not only by the upward trend line that I've drawn, but I'm also getting it from the candlestick chart pattern. So I'm getting the idea that it might be an extra confirmation out there. Now I feel more confident in my trade. If I wasn't using a candlestick, for example, I wouldn't see that three-soldier pattern, because I wouldn't necessarily see that. So that's where candlesticks can be very, very helpful. And what I would tend to recommend them using with trend lines in almost all cases, but you can switch over every once in a while too, as far as sometimes it works better with certain types of lines or certain types of prices. I'll actually demonstrate some of those. Well, once I draw a trend line, is it permanently fixed? Does it just stay there? It never changes or anything like that? And it would typically will for a certain periods of time, but in general, no. You do want to have a definite slope, and you will use straight lines and all that, but you might need to adjust those starting points or adjusting those points a little bit as things change on your chart. So it's more of a dynamic process. You might, let's say, have an uptrend, for example, and this goes sideways a little bit. Maybe you're starting to draw another trend line to show the sideways movement, and then it goes up or goes down. So you might have multiple trend lines on a longer term chart if you're trying to really get a feel for a longer overall pattern. So do think of trend lines as a dynamic process. So as we go through these chart patterns, you'll see us throughout the lessons drawing these trend lines. And in that part, we'll get an idea of kind of where to start the trend line, where to end the trend line, when prices break through a trend line. That's what you're going to be learning all throughout this. But think about some of the basics that you learn in this part. And then as we go through the next part of the lessons, and we look at continuation and reversal patterns, you'll see how we're using trend lines in the drawing of them in those lessons and how they all work together. So let's start getting into that as far as how to actually draw these lines, and more importantly, how to trade off these trend lines. One of the most important common things you're going to do is actually drawing upward trend lines. You want to identify an upward trend so you can buy in early in the trend, ride that trend out and get some profits, and then later you'll sell when that trend starts to end. So drawing upward trend lines is very important. So and what you'll be doing maybe all the time if you like doing trading off of trend lines versus, let's say, other indicators, but always a trend line is a strong indicator on its own. So let's take a look at how to draw and how to trade on trend lines. In this lesson, we're going to talk about specifically how to draw and trade off of uptrending trend lines. So when you're drawing an uptrend trend line, that's going to be really your support line, right? You're looking at your lowest lows, and you're going to connect to your next lowest low that precedes a new high. Okay, I'm just going to cover these 3 bullets real quick. It actually makes much more sense when we look at the graph, so graphically, but it'll make more sense there. But the idea is that as long as new highs are being made, you redraw the line to connect the lowest low before the last high, and then and when prices stop making new highs, then you stop drawing, and you extend that line at the same slope in the future. If anything to take away from it, you're going to draw this long slope line. It's going to be an upward facing line, and the idea is you're going to buy towards the bottom of or the early part of the trend, and then you'll sell towards the upper part of the trend, and then in between will be your profit. So this is kind of the specific definition about it, but let's look at the example and how to trade off that to make this make more sense, because that's a little trickier to just talk about it. Let's now actually show you how to do it. So as you can see on this particular example here, we have a starting point. So we're picking kind of that lowest low as a starting point. If we look at, let's say our chart looks like this, we're going to that lowest low, and then we're going to start connecting those other lows, and we're looking at trading ranges here at the bottom of the trading range. We're basically doing it off the bottom of the wicks. You could trade through the middle of the bars, by the way, just be consistent if you do it that way, but almost everyone does it this way, where you're looking at the low of the lows, and I prefer it that way, and that's how I'll demonstrate it, but it doesn't mean you're wrong. Just whatever, if you want to go through the middle of the candlesticks, just make sure you're consistent. So as you can see, I've drawn this line, and I've connected these lowest lows, and so if I start at the bottom left where that blue line is, you can see the lows approach it like 3 times, right? That first kind of red long wick bar doesn't exactly touch it, nothing's perfect, but it gets close to it. Then there's another like doji type bar where it's a very small candle body. It's also red, showing us that the closest was lower, barely lower because it has a small body, but you can see that there's a low to the bottom there that comes to the bar, and then we had an uptrend or an up day, and you can see a shorter wick on the bottom there, but you can see where I've connected those together. So it basically is connected 1, 2, 3 points there. And a lot of people will buy on that second or third touch. That's the idea of when they're buying. And this will introduce us to now our rules around how do we trade around this. So this is how we draw it. Now how do we trade on this? So there's 2 rules around this. One is called the support line entry rule and the support line exit rule. So the support line entry rule says that you buy on the second or third touch of the support line. In this, where I have the arrow here, you can see it's on the third touch of that. It could have been on the second touch or near touch of that support line. That's when you're buying in. You're in an upward trend, you want to ride the upward trend, that's when you're buying in. And then when you want to exit, once that support line is broken, right? Sell as soon as possible after the low in the range, falls below the support line. That means the trend is broken. You can see it's approached it, but it's gone past it. In terms of the classic support line entry and support line exit rule, you're basically selling as soon as it breaks that blue line. And what's happening here is you want to confirm that the trend really is forming, and that's why you're waiting for a second or third touch of the support line, because that establishes the trend more. In fact, the more touches it has, the more established the trend. So a 4th or a 5th touch would show a very established uptrend in this case. And the reason you want to exit out of quickly is you want to take those profits, book those profits. You're not hoping. Once the trend line is broken, the trend line is broken, and that's where you want to then sell as soon as it hits that support line and get those profits in there. So if we look further along here, let's say we had bought on that third touch, and you can see how we've gone up. It's actually had like another touch there, and the price has gone up, and we get to a point where it goes below the blue line a little bit, and that's when you would sell, right? That first time it breaks through that blue line. Certainly when you have that other candle on the right of the line there where it's really definitely gone below it, you definitely are selling then. Is the idea behind it, because the trend is now broken. Now it could go sideways from here, it could go downward, but the definite uptrend has been broken. In fact, I took this from a real security, and this is what happened afterwards. So you can see it actually really did break the trend and start heading in the opposite direction. So I wanted to sell and get that profit before it went down and ate up all my profits. That's the idea behind this. So I'm watching that trend line, I'm buying on the touches, and I'm selling once it crosses through there. And it's kind of extra credit and how trend lines can kind of combine with other indicators. If we were to look at this, is there something more going on here once we reach this point here, right? So let's say we bought the second, or let's say we bought on the third touch, and then we have the next kind of, let's say, periods happen, and you see those 2 last candlesticks. I've kind of covered up the other candlesticks for a moment because something's going on here. Do you see the white body candlestick, the second from the last candlestick, and then that big red candlestick there, and then I've covered up what happens after that. But if we were to look at that, we'd say, okay, we're in an uptrend, but that looks like something, right? Think about our candlestick lessons, or think about candlesticks, and this is extra credit, but if you were to say to yourself, that looks like an engulfing candlestick, right? We're in an uptrend, and that one big candlestick has engulfed the big red one has engulfed the other one. You would be correct. That is, as we learn about candlesticks, or learn the candlestick lesson, that is a bearish engulfing candlestick. There are bullish engulfing candlesticks too, but this is definitely a bearish one. It means the prices are about to go down. And why is that? Because we were in an uptrend. You had a red candle body fully engulf a uptrended let's say white, or it could be green depending on the color, but you have the red candle, a down day, engulfing the previous closing up day. So that's telling us from a candlestick pattern that there might be a turn here and going to a downtrend. You want to wait for that to fill in the next day where it should go back now downwards. And in this case, it went down. The close we had one in between day where actually the close was a little higher, but it broke that trend line. See where it broke that trend line for part of the day? That would have been a sell signal in itself, and maybe we should have sold there. You can sell there. That's the idea of a true support line breakage that you are selling there. But if you were to wait it out a little bit more, you definitely would have a sell confirmation, because now you've got a red bar, red candlestick price bar, you've got an engulfing, bearish engulfing, and you've got a breakage of the support line. I mean, that's definitely, and if there's anything telling you get out, that's telling you to get out. And so that's a little extra credit on this one first, this real one that we pulled from. And then as we look at the pattern after that, you can see, and this is from a real security, you can see that, boy, it went on a real tear downward. Look at all those red candlesticks right in a row there, just down, and then it reached the bottom and then went back up. But in the week, maybe there's a new trend we can form to trade on that new upward trend to the right that might be forming. But if we look at this, we can see we had a nice little uptrend, we bought in there, we made some profits. That bearish engulfing candlestick was worrisome. Maybe I sell there. Maybe I'm hanging on for the trend line to be broken. But once it is, maybe that's the time to get out. I got a lot of factors telling me sell, so to speak. So upward trends are great. It helps us to buy low and sell high as we go up on the slope and we go up on the trend as the prices increase. But it's also very important to understand downward trends, and so we're talking about downtrends and how to be wary and how to trade downtrends and be working through those types of trend lines. So in a downtrend, what you're really drawing is not support lines, you're drawing resistance lines. And again, this will be much more sense as far as when we actually draw the lines, you see the examples. But basically, you're starting at the highest high, you're looking at your candlestick at the wick of the highest high, and you're connecting to the next high that precedes a new low. And you can see this line here, it's going to have a downward slope. And as long as new lows are being made, you keep redrawing the line to connect the highest high before the last low. So you're drawing a line along the highs, but it keeps going downward, right? That's the whole idea of a downward trend. And when prices stop making new lows, then you stop drawing, right? And then you extend that line at the same slope out in the future. You want to see how you're basically extending that line all the way out, and you're watching that trend line. So let's look at that graphically so it makes a little bit more sense here. If you see this downtrend here, you can see where I started. The highest high, in effect, is where I'm starting at. I'm at the top of the candlestick now in the upper shadow at the top of where that wick was. If the wick on where my starting point was in the far left was even higher, I'd be starting up even higher. I would always start at the top of the wick in this case. And then I would be connecting it down through these next ones that connect along the slope, as far as you can see where it's this downtrend has really been established. Where it says downtrend established, that arrow that's showing at the third, a real close approach or touch of that downward trending line. You can see I had a first one there, I had a second one there. In fact, when the second one happens, they're right in a row there, that could have been an established downtrend right there. A lot of people would consider that's fine, but if I really want to make sure, I can make sure it touches for a third time along those lines. But you can see we have a downtrend that is established, and you can see our downtrending line along those lines, right? So now we're watching this. We're waiting. We're either, if you're short selling or betting on prices going down as far as a strategy, you can continue to sell this, basically be trading along it, expecting lows to keep going lower, and they do. And let's say they keep going lower, and we now have a fourth test of the resistance line, right? So we can see that our resistance line there's been another test of it. Though this case, the prices went up and they stayed up. You can see how we've got white candlesticks where it kind of started to go up for 2 days, let's say in a row. So that's a little bit interesting versus the third downtrend. It had a spike up in prices. People were trying to get it above that trend line in effect, but it went back down and went way back down. And you can see where it had that third touch, had a real red bar with a long upper wick. In this case, the buyers are trying to drive that price up on the fourth touch of the resistance. So that might be telling us something, and why candlesticks are helpful, that maybe buyers are trying to do something here. Will they break through that line or not? That's what we want to watch for. Are they going to break through that line and break the trend, the downward trend, or will go back down again and keep going on that downward trend? By the way, if you look at that last price bar we have there, it might look like a dragonfly doji. It's not. It's got a little bit more of a body to it than a lot of dojis have, but it's kind of doji-like. But it's not technically it's not a dragonfly doji because there's no prior established uptrend. For a doji, you need to have an established trend, and we don't have an established uptrend. In fact, we're still in a downtrend, so it wouldn't really consider it as a doji and trade off it as a doji. But if you're looking at it and thought, hey, maybe that's a doji, good for you. All right, so let's see what happened in this particular case. Again, a real security. So it approaches that resistance line, but doesn't break through. But then you can see on the day after, it definitely breaks through that resistance line. I mean, it actually almost has a full gap up, but the whole candlestick body and the price ranges on the upper and the lower, all of them have gone completely past that breakthrough, or it's broken through that resistance line. So that's a real telling that it really has broken that trend. Even if the upper shadow just goes past that resistance line, for many people, technically they'd say, yeah, once it does that, that breaks the rule as far as the resistance or the sell rule, and so we'd be, or excuse me, in this case, it breaks the trend rule, not necessarily sell rule, but it breaks the trend. So the trend has been broken. The downtrend is broken, and then it kind of goes sideways and it kind of goes on from there. But when we were looking at this trend forming, we established that there was a true downtrend. We watched it approach that fourth time, and then it could have kept going back down, or in this case, it strongly broke through that trend line. So we strongly know the downtrend has ended. Let's talk about channels, and channels can kind of provide some good opportunities for trading, as far as trading within the channel and also recognizing when a channel pattern is going to be broken out of. And a channel, as far as for trend lines and simply drawing a channel trend line, is simply drawing the support and resistance lines on the same chart. When we were doing downtrends, we're connecting things. We're doing uptrends, we're connecting things. We're now putting those support and resistant lines in the same chart. And one thing when you're doing this, you want to take note of which one is the predominant trend, right? So we're not looking at things that are not trending or something like that. We're trying to get some definite patterns around here. And if there's a predominant trend coming in, like an uptrend or a support trend coming into our resistance or into our channel, we want want to take a note of that. And you might say, well, this kind of looks like a rectangle, and they can, and they usually do as far as that, but they can also form other types of things too, as far as a channel or a range of where there's trading happening between the resistance and the support line. So if we looked at this with some of the examples we've given before, you can see on the left there, we had our downtrend established, our downtrend ones, and so then we just connected the two lows there, as far as the other end of the range from the highs to lows, and you can kind of see how a channel is formed, and there's things trading in between the channel. So for example, on the left there, where it had broken through, where the downtrend ends, let's say the downtrend hadn't ended, and it turned back down towards going lower, then we would be watching that other channel to see if it would hit that support line at the bottom there of that channel, and then rebound back up. Might be something or trade with inside the channel. But in this case, it did break through, and it formed some new stuff. You can see also, or some new trading, kind of sideways, up and down type patterns. Until really getting now that we saw on the right, the same deal where we are connecting our tops and our bottoms, and now we have a new, in this example, have a new downtrend. Look at all those red close days in rows. There's 6 of them there, and you can see a pretty well-formed channel, forming along that too. Is the idea that we're looking at is basically connecting the tops and the bottoms to kind of get a view for the channel. If we looked at another one, let's say on an uptrend, and this is the image you've seen before when we were talking about uptrends, you can see we had that bottom line, the support line, and we're buying on the second or third touch. In this example, let's say we're buying on the third touch, and we're now connecting the highest highs as far as looking at that channel, and you can kind of see it more spreading out this channel. And this is where you can get into more of a dynamic process, because you can look at that and say, well, maybe if I adjusted my lines and didn't start that first day there where I started lines, maybe I go 2 days in, it might look something like this. Well, then that seems to be a little bit more of a narrower range, a more maybe accurate type thing as far as understanding what my channel resistance line on top might be, right? So there's a difference between those two different ways I drew it. The first way was an accurate way, but the second way, if I was also to start my support line at the same spot, ideally that's what you should do, or you could do. But you might say, okay, this looks to be a little bit more accurate as far as what's going on, at least at the current moment. And then you can combine this with other things too, just like we saw that bearish engulfing candlestick. This might help where I'm looking at the channel and I see that that big red bar engulf the previous up close, where it engulfs that, and I can see that big red bar hit both my top, my resistance, and my support line at the same time in a trading day. That's a pretty wide movement, and it's a bearish sign because it's a candlestick pattern showing a bearish sign. And then what happens next is I get my support line broken, and I could have sold then, or certainly when I get a full break of the support line, I can sell then as well too. So that's kind of showing me my channel and how my channel is kind of being worked in that channel, and then combining it with my trend line, and then combining in this case with a candlestick pattern too. So a couple different ways that you can look at or combine it too, to kind of, you're basically trying to get a visual clue as far as what's going on. And so channels can be helpful when you're looking to maybe sell at resistance lines or buy at support lines, for example, or we start seeing things where we see a trend line being broken. Seeing that full channel pattern might be able to help us there as far as understanding what might be going on with that trend as well. So another tool in your toolbox that you can use when you're drawing your trend lines. Since we live in an imperfect world, even our trend lines are imperfect, as in sometimes you get false trend line breaks, right? Where it breaks through a trend line, and it's supposed to keep going after the break. It's supposed to, not go back above the trend line, or not, go back into a trend, right? It has broken the line. There's a rule around that, right? Once the trend line is broken, the trend is over. So that's a very important rule to follow. But a lot of times, something's happened. Maybe there's a temporary amount of noise, or there's some buying and selling that's caused something to happen that's only a temporary false break, as opposed to a true break of the trend line. So we're going to talk about the next couple lessons. We're going to talk here about how to identify these false trend line breaks. At least gives us the best chance at this real vexing challenge. And then also we're going to have a strategy around how can we approach these false breaks and manage them in a better way when they may occur. So first off, let's go back to the rule again, right? Once a trend line is broken, the trend is over. That rule will serve you well. That is a very, very well-established rule. And it really takes emotion out of it, takes hope out of it. Oh, I hope it comes back above the trend line. It takes all that out of it. So there's nothing wrong, in fact, very good, that once the trend line is broken, the trend is over, and to stick with that. However, false breaks do happen, where they're breaking that trend line and the trend isn't over. It goes back into the trend, very quickly. So in this lesson, we're going to keep talking about how to identify those. And then the next lesson, we're going to talk about the strategy and how to deal with them as well. And one thing to note about this, the terminology is like a false breakout, but it's actually, they're not false. It really did happen. The trend line really was crossed. It really did happen. But what ends up being false is the conclusion you draw from it. In a way, you are misled. It happens all the time. And we're going to look at how maybe to possibly identify these things so we're misled less. There's three good ways to kind of look at this. And one is, in terms of how to identify, is did the breakout occur as part of the range, or the final close break it as well? And what we mean, did the actual close of the day, break through the trend line? So, for example, if we look at this image here, we've got a downward trend. It's established on the second touch of that downward trending line, that resistance line, and then we get this long. Let's say in this case, I adjust a little bit. You see this where we have this long red candlestick with a long high range at the top there, where that breaks through the trend line. It broke through the trend line. That counts as a trend line breakage because it did break through. However, the close of the day, which is at the bottom of in a red candlestick in this example, did not break the trend line. It ended up going back into trend, back below the trend line. So that can be an indicator that you might have a false breakout. And it could also be on the upside too. Here you see the next arrow where there's a false breakout, you can see it was actually an up close day. Following the previous day was an up close as well, but it was up in terms of the close. But the close did not go above the trend line. The range did, the highest highs as far as the price range, but the open and the close, and specifically the close, still finished below the trend line. So it can happen in either case with either type of candlestick. And so these are one way to indicate it might be a false breakout where it got pushed up high enough to break the trend line during the day. The rule would say you would sell then, and that's perfectly fine to follow. But if you're worried about a false breakout or you want to push a little bit further, wait for the close to go above it. And then you can see the last candlestick we have here. Not only did the close go above the trend line, but also the open went above the trend line, and even a whole range of highs and lows, the whole candlestick and its upper shadow and lower shadow, its wicks, all of it finished above the trend line. So that would show, yes, this downward trend is definitely over at this point, and it's not a false breakout. So when the close breaks through, it means it's less likely to be a random event or noise related. That means people are kind of finishing their positions, closing their positions for the day, and so the close as the final price of the day is more a much more accurate way, or at least an identifier that this might be a false breakout if it doesn't break through that trend line. If it does, then it's very well established that there is a breakout and the trend is over. Another way you can use that, in combination too, or use on its own, is to look at trading volume. How much buying and selling is going on, right? So if there's a high volume or a volume spike, that often accompanies the end of a strong trend, whether it's a strong uptrend or a strong downtrend. There's a buying and selling frenzy that's breaking through that trend line, that's causing that to break through the trend line. And associated with that, looking at the bottom of your chart where you've got your vertical bars showing opening, closing, or volume. Excuse me, looking at trading, how many transactions are happening. When you see a spike in that and it's breaking through a trend line that you've drawn, then that's a pretty strong indicator that the trend is over. A steep volume decline shows that overall interest is waning and may signal a breakout. Right? It hasn't necessarily happened, but it may signal that interest is waning, may signal a breakout. And if there's steady volume, then it's less likely for a breakout. But be wary, as any cross of a trend line is also significant. So we're looking for a false breakout in this case. The trend line has been crossed. We know that's happened. We could be taking action just on that. But if we see, boy, there's a lot, the volume is not really spiking or declining or anything. It just kind of seems steady. Then there might be a chance that this is a false breakout. But high volume, whether it's high or low, may signal that this is a true breakout. So be wary of that. But when it's steady, might be like maybe you can push a little bit further as far as that maybe it's a false breakout. And then lastly, a good tool to use is your other indicators, right? You can use your other indicators to help confirm or possibly disregard a breakout. Like, okay, they broke the trend line. Other indicators are saying the trend's changing. There's a reversal going on. Okay, I got it. So if it's an uptrend, I'm selling because not only is the trend line broken, but my other indicators are saying that too, as an example. So using multiple indicators is always a sound idea. And we'll learn about that later as we talk about how you can have primary and secondary indicators and how to use that type of strategy, or third or fourth indicator. So multiple indicators, can be very helpful. And sometimes they can give conflicting signals. They certainly can. And that's why sometimes you'll want to give more weight, that you would choose more weight to certain indicators than others. And you'd also want to look at your own risk profile. If you like less risk, then if a breakout occurs, just get out, right? You might want to just get out with a well-established rule. If the trend line is crossed, it's broken through, then you're out. Or if you're seeing a little bit more confirmation, even if there's confliction, if you want to take on less risk, then you want to get out right away. If you want to push it more again and see if this is a false breakout and take a little more risk, a little bit more downside risk, you can do that. Again, this is more about you and your trading style and your plan. And sometimes a confirming indicator can give you an advance warning to be on the watch for a breakout, right? That something might be coming. We saw that in examples where we saw a nice upward trend line, things were looking great, and then all of a sudden out popped this bearish engulfing candlestick, which is a real clear indicator that a reversal to the bearish, to the downside might be occurring. And we saw that occur. You could see, okay, our range went below the trend line. That's a breakage. We would sell just on that breakage, just on that because it broke. And the fact that it's an engulfing candlestick, or looks like it's one coming, we might have sold just based on that. You'd want to have that next day, that last red candlestick to kind of confirm the bearish engulfing candlestick. But between breaking the trend line and it's getting set up as a bearish engulfing, there'd be nothing wrong with getting out right away in before that. And if you want to wait a little bit more till it fully breaks that trend line, as it did here, and not only with the close also broken, in addition to all the ranges broken, that's fine too. Then it's really super confirmed. But you can use your indicators again to help confirm what you're seeing with your trend lines and help your decision making by combining and using other indicators when they happen. So that's a little bit about identifying trend lines or identifying false breakouts. Not easy. It is the number one challenge out there. But if you can start using some of these ideas, you can decide, and based on your own risk profile and what you want to do and how you might manage your trades, to start deciding like, okay, how is that going to affect my decision making? Again, if the trend line rule is broken, you can always use that established rule. But if you want to try to see if a false breakout is happening, use some of these ideas and see what happens. And you might be rewarded in terms of, let's say it's an uptrend and it picks back up, or you might have taken a little bit more loss, hoping that the false breakout wasn't really occurring, and you wanted to let it prove itself a little bit, and it ended up being a real breakout. And then you need to act accordingly too, with that extra confirmation. Okay, so we talked a little bit about how to identify that a false breakout may or may not be occurring. And if that's so, what are some strategies we can use to help us become better traders along that as well, when we think that a false breakout might be occurring? So that's what this lesson is about, is your strategic approach to these types of things, these false trend line breaks or potentially false trend line breaks. And once again, hard fast rule, once the trend line is broken, no matter how it's broken, the trend is over. That is the hard fast rule. Again, you're well served following that rule, takes emotion, hope out of it, takes a lot of extra analysis out of it. So nothing wrong with that as far as once that trend line is broken, the trend is over. However, false breaks do happen, frequently happen. So there might be ways that we can use a strategic approach to really kind of deal with them and help us be better traders. And we're going to talk about how we can use support and resistance lines in terms of our strategy, but also how to apply filters around this too in this lesson. So let's get into that, how we might be able to deal with these potential false breakouts in terms of strategy. So here's an old friend here. Let's say we saw this happening, right? We saw this image here on the left there, as far as you've got this nice uptrend that you bought into this nice uptrend, and before you see the definite turnaround there, but let's say you're seeing this uptrend, and you first see the support line is broken. And you're thinking, you know what, that support line's broken, but maybe that's just temporary profit taking. You can see we had this nice long trend before that, and we bought in on in this example, on the third touch. But let's say if you bought in sooner even, then you'd have this nice long trend that you've been making a nice profit. And maybe there's just some temporary profit taking. Maybe it's just going to go down or sideways a little bit and then resume that trend. So if the close is below the trend line, you're thinking, well, maybe it might be okay to hang in there a little bit, just hang in there a little bit more. So if you were to use this as a strategy around that, what you could do is adjust your stop loss order to kind of lock in profits, right? We saw when we bought, you put in, look at the lesson around stop loss orders and how to use these orders, but basically you're going to set a stop loss at a certain point. In this case would be moving above what you bought it at. So if you're wrong and it's not a false breakout and it keeps going down, you'll be able to automatically sell because of the order you placed and lock in some profits there. The other thing you can do, like in this example, is adjust the total amount of the money committed to the trade, right? So let's say we bought in here at a certain amount, and we could say, okay, we're seeing some bearish signs, we're seeing support line breaks. Instead of selling everything, maybe what we do is we sell some, but not all of it, to reduce the risk and lock in some profit. And then we can sell all of it later on as we get a more definite sell signal as it starts to make that turn. So the idea is I've made a profit, I'm going to lock in some of those profits. I think I might have a false breakout, maybe some temporary profit taking. I'm going to hang in there a little bit with a smaller position, a smaller amount committed, because I've already taken some of it out. And if it looks like it goes south and it's really just, it is a definite breakage and it keeps going down, as in this example it does, well then I'll sell at that, I'll sell and still make a profit, but I'll get out of it completely at that point. And then I'll sell it all later on as I hit that more definite sell signal. So you see in this example here, where we have buy, and then you can see where it crossed that line, and maybe you're saying, I might sell here, but I might not. Let me hang in there, and then it starts to see where we're definitely having a close all the way below the break line. Now we're really selling at that point. And maybe we already took out some profits at the sell maybe, and then we took the rest out of the sell definitely. But if it had turned and gone the other direction, then we still have some money in, and then we could keep running that trend. And again, with all this, you don't have to be perfect, right? You want to start using strategies to help lock in profits and things, so you don't have to be perfect on all this. You just have to be kind of smart about it. Another way things can happen is, let's say a resistant line breaks, right? So the buyers or the bulls have broken through. You were on a deep downward trend, and it's been broken through. The trend is well established. You can see the downtrend here on this image is established. You could have bought, you can see that on the second touch or the third touch, there's definitely a downtrend established. Even the fourth touch, you could say, well, it's still part of a downtrend. And the question is, will it become a new uptrend once it's broken through, right? We're looking at, is this a false signal? It's already broken through. This whole idea is it's broken through. So the strategy around this on a resistance line break, it's been in a downtrend, it's broken through. Will this become a new uptrend? So the strategy, wait for the second or third touch to buy into the new uptrend. That's our orange line there. You can see we got a second touch there, especially since we're coming out of a real steep downtrend in this particular example. This might be a case where it might be safer to wait for a third confirming, real establishing a third touch, just to be sure, just because it just came out of a big downtrend in this example, for example. And that's the orange line there. Another thing you do is what's called selling short, and basically you're betting the price will continue to go down at number 2 or number 3 touch of the resistance line. So we're back in the blue numbers there, and you're seeing it. You can be selling short at those periods, and then you close your short position once it breaks through, and then a resistance line breakout. So you're booking your profits at that point. So you're kind of betting this in terms of that way, or investing it that way. When we get into order taking about how to sell short and how to cover your shorts, we'll get into that, how it works. But the idea is, you think it's going to go down, you're investing in a way that you're betting on it to go down. It does go down, and then once it breaks that line, you're getting out. So again, you don't have to be perfect with any of this. And really, for most people who aren't selling short, they're really doing that first strategy of like, I see it's breaking through, I'm waiting for the second or third touch to buy in a new uptrend. And if that doesn't form, then I'm still staying out. I'm still staying on the sidelines. That's okay. I'm watching for new trends or new indicators, new confirmations to come along with a resistance line break. There's also there's some interesting rules out there, or different ways you can approach it too. Beyond this, that's the core part. One interesting one is the 1-2-3 rule. Is created by Trader Vic, a famous Trader Vic, author as well. And the whole part of this and all this is the goal is to manage a big challenge of these temporary pullbacks. In this case, of an established uptrend. So the 1-2-3 rule is related to definite established uptrends and trying to sell out of a temporary pullback. You want to try to run that. You want to keep running with that trend. It helps you to not get out too early. So if you were, let's say, bought early in the trend, you had this nice run up, then it pulls back. It's the idea of the 1-2-3 rule is that you're not selling during the pullback. Even across the trend line, you're not selling during the pullback. You're trying to work through this temporary challenge as far as a temporary pullback, so you can keep your money in and let that profit keep running. So how does the 1-2-3 rule work? Let's take a look at that. So let's walk through this in steps. So first off, let's say on this particular one here, you can see we have a nice uptrend. We bought on the second touch in this example, could have been on the third touch, but we bought in there, and you can see we have a nice price run up, nice profit up there, and then we see cross the trend line. That's our sell signal, and so that's the first time we tell us, oh, we got to sell, right? As soon as it breaks that line, we're selling. Or if you want to wait till it's a full close across, you can sell then too. So, but you're looking at this line and you're saying, I don't know if I really want to sell. And there might be some really good logistical reasons behind this, or tactical reasons, not hope and praying, but really some things that happen. If you look right before that sell, going back from the sell thing, you see there's a gap up, right? There's a jump between the two white candlesticks where the prices don't overlap, or the price range doesn't overlap. A gap up is always a good, bullish, sign, right? It doesn't mean it's necessarily going to happen that way. They'll keep going up, but it definitely is a good sign that something good is happening. So you had a gap up. And then also you see there we have all these higher highs. We have these high closes all in a row, 7 of them since you bought, 1, 2, 3, 4, 5, 6, 7. Since you bought, it kept going up 7 straight times. So that's good too. But then now there's this temporary pullback, or maybe it's a temporary pullback, you don't know, but you reach that peak and then you start seeing that the prices now start going red, and the candle starts to go red and it's starting to go down, and it crosses that trend line. So with that good stuff, all those high closes in a row and the gap up, do I really sell because it crossed that trend line, or are people just taking some profits and they're just doing that? How do I apply my 1, 2, 3 rule to this is the idea. So here's how you do it. So let's put on some lines on this, and this is how the 1, 2, 3 rule works. So first thing you do is, in order for the 1, 2, 3 rule to be activated, you have to have the support line broken, right? That's the whole idea. You're trying to see if there's a false signal. So first step, it's got to be broken, right? And you can sell right there. That's always the established rule. You can just sell there. But if you want to try 1, 2, 3 to see if it's more of a false type of breakage, then the second step you would do after the support line is broken is you're watching for it to test of higher highs. You might go down a little bit more, might go sideways, but then you're looking for a turnaround and for it to go back up and test the higher highs. That's that number 2 there. See how I draw on a line? Whatever was the highest point of that trend before it was broken, that's where I'm going to draw my line for my number 2 of the 1, 2, 3 rule. And you can see it was actually a red candlestick. It was a down day, but the bulls, the buyers tried to push that price higher. They tried to keep going with that uptrend, tried to turn that into an update, but the bears, the sellers won out on that day and pushed it down and then kept pushing it down past the trend line. But that's where we're looking at that highest high on number 2. And then number 3 is where you look at where the previous significant low was. And this could have been higher up in the trend line, but not in this example. The previous significant low that approached the trend line is where you draw a line straight across. That'd be your number 3. And once that's broken, then you have real definite confirmation that this is not just a temporary thing, it's a definite thing as far as a turnaround. So if we look at the 1, 2, 3 in this example, you can see, of course, the support line was broken. And the highs, they had a little pullback, had a little turnaround, but it never really tested that higher high. See how the highest point after the support line, after the trend line, never got up to number 2, never broke through number 2. It was really what we're looking for. We're looking for this to have worked. In this case, it didn't. It should have, if it worked, it would have been breaking through at number 2 at this point, and then establishing or reestablishing that strong trend after a temporary pullback. That's what we'd look for, is that breakthrough of the number 2 of the higher highs. And it didn't. Instead, it went down. And maybe it went down a couple more days, a couple more red bars, and we're saying, well, maybe we're just in a little pullback, a little narrow trading range. It's going to go back in trend, going to try to come back to that number 2 and go higher high, but it never did. In this particular example, it went down to the number 3 line, the test of the previous significant low, and then broke right through it, right? It broke through, and that's your confirmation. As soon as it breaks through, that's enough confirmation, and you're selling at that point, to get out once it breaks through that. So as you can see in this example, I would have made more profit in this example if I would have sold at number 1, if I would have followed the rule, and not tried to test for a pullback. If I would have broke through at number 2, then I would have been rewarded on that, right? So the idea is you're looking at other confirming factors, you're looking at things to see how temporary this pullback is, or if it really is a reversal, like in this case. But even by setting my 3 at the previous significant low, between when I bought and that previous significant low, I made profit. I did not make as much profit as I would have from the green arrow up to the number 1 where I sold in this example, but I would have still made some profit and tested out the pullback there. So this is in a case where it didn't fully work out as far as, it worked out in terms of still getting profits, but didn't work out as far as hanging in there through a pullback and then breaking through number 2. And that's the idea of the 1, 2, 3 rule. You're looking for it to break through number 2, and in your downside, you're protecting yourself with the number 3 as far as your significant low confirmation. Another strategy you can use to kind of test to see if something is a false breakout, is breaking through a trend line, is to apply a filter. And we can use filters in lots of different types of indicators, but we're going to talk about applying a filter in a trend line, and specifically, applying something when trend lines are broken, for instance, in terms of, trading mechanisms. So let's talk about that. So at its base level, a filter is simply a modification of any trading indicator. And basically, you're setting a predetermined rule on an action that you'll take when certain conditions are met. All right. So that's just the key thing. It is predetermined. You've already decided that when this happens, then you will take a certain amount of action. And we're talking about this specifically with trend lines, but you can use filters with different types of indicators as well, and some work better than others when we get into the lessons around more detail around filters with other types of indicators. But in this case, we're looking for a trend line breakage, right? We're doing a filter, a predetermined rule that when a trend line is broken, we can modify the clear rule of whether to buy or sell by adjusting it with a filter. And that filter can be an amount or a percentage of the break. So it needs to break by a certain percentage before we'll take action, not simply breaking, but has to do so by a significant or certain amount of percentage breakage, or duration or time of the break. How many, let's say, time periods, maybe a day or days after before I take action. So I'm not taking action immediately. I might be taking action because I've modified my indicator to let it kind of be out there a little bit more in terms of time. And the key part again of all this with filter conditions is they need to be met in order to take action. You predetermine this and you said, okay, I'm going to do this. I'm going to follow this plan is the idea. So let's look at an example that will really kind of bring this home. So let's say we know the support line exit rule, right? So you're selling, you bought into an upward trend, and you're going to sell out of that trend as soon as possible after the low falls below the support line. The low, anytime in that low price range during the day, the support line is broken, the trend is broken, you're selling. That's the rule, right? So that's the rule. Now let's modify or filter this rule is another way you could approach it. So you're not selling exactly at that point. You're trying to give yourself a little bit more to see if it might be a false or temporary breakout. So ways you could do that is say, okay, I know the support line exit rule says I should sell as soon as it breaks the line, breaks that support line. But I'm going to have an amount type rule, and it might be like something like, once the price range, I'm going to say the price range has to break the support line by 10%, then I will sell. So it's not simply enough that it breaks it, it's got to do it significantly by 10%. Or I might say not only the range, I might say, well, the actual final close has to break the support line, and that has to not only break the support line, but that needs to do it by, let's say, 5%, then I will sell. By the way, these numbers, 10%, 5%, those are not etched in stone. You can use your own numbers, and you'll want to, as you learn your securities or maybe the universe of securities you're trading, you might make those numbers lower or higher, depending on your risk level and how much profit you want to book. But also, like some securities have wider, ranges of, of trading, and so 5% or 10% might be too low. Maybe you want to make that even steeper, or vice versa. You may make that 2% and 4% or whatever. You can pick one or both, either way. But the idea is you're picking an amount that the price range has to support buy in order for you to take action. In this case, we're looking at breaking a support line to sell. So in this case, we would sell. You can also use a duration type of rule too as a filter. And for example, you'd say, I will allow one full break of the support line, but not two. So that means if it breaks the support line, on one day, let's say we're trading on a day, and you're like, okay, it broke the support line exit rules, I'm supposed to sell as soon as possible, so I should be selling now, but I'm going to set up a filter and a rule and say, I'm going to wait until it breaks it twice. And if it doesn't break it twice, right there in the following day, then I'm sticking in there. So that's the idea of making these a little bit more filtered out. And again, these are examples, adjust your own securities and as you gain experience and what you feel comfortable with too. But the idea is I'm not following the hard and fast rule of the line was broke, I sell. I'm putting some filters or modifiers to it to allow me to stay in a little bit longer, put a little bit more risk, because I'm taking a little more risk around that rule, but I'm also trying to filter out a false breakout is what I'm trying to do here. So if we look at this example here, the same example, we could see that, okay, we bought in on the second touch. We're in a nice uptrend here. You can see that when it breaks the line there, right at A there, we should have been selling right away if we followed the rule to the letter. It broke the line, we should have sold. But let's say we had a filter that said we have to not only break it, but it's got to break it by 10%. We would say at the letter A, estimate here in this example, but we'd say, okay, we're not going to sell here because it didn't break the line by more than 10%, right? So it didn't break the line by more than 10%. We're not selling because it's less than 10%, really is the way to look at it. So it's no sell. The break is less than 10%. It's no sell on A. Now, if we look to B, now that it's broken past the line a second day or stayed below that line, we can say, oh, we're going to sell because the close of that day is greater than 5% breakage through that line. Not only broken through the line, but the actual closing of the day, that was our second example. Now we're selling because it broke through. And then if we were applying C, we would say, okay, we're not going to sell on the first full day because that's B. So let's say we're looking for a first full day of a full sell through, and that was our rule, our modifier, and we wouldn't sell on B, we never would because it's only the first day, but we will sell on the second full day that's below the support line. So this was, again, our rule was the first full day. You can see A was not a full day as far as being below the close being below the support line, right close to it. You can say maybe right on it. But the first full day we can say is B, not selling because that's our rule, our modified filter. And then the second day we're going to sell on the second full day, and so that's when we're selling on C. The unfiltered rule, without that would say, okay, you're selling as soon as you're breaking that line. And you can see, okay, well, we've got these things in place, and then we have this little turnaround, and maybe it'll start a new uptrend, right? But maybe we held in there a little bit longer than if we would have sold right at the line. Again, who knows what else is going to happen after we break through the trend line? If anything, we know what's supposed to happen is the trend is broken, but there are temporary pullbacks, there are false signals, and so this would be a way to kind of filter out a false signal if this was going to go back upward is the idea. But that's how when you make your predetermined rule, then you follow your rule. You got to have discipline around that. So if you're using a filter strategy, there are definitely some arguments against using filters for trend lines. There are good arguments for using filters for maybe other indicators, but for trend lines, there's some good arguments against them, and you should be aware of those. And one of them is that the breakout principle is a very powerful and well-known concept. If you just follow it and you don't play with filters, you're going to be fine. And that's very true. In fact, that would be, I would say, the number one argument is stick with that powerful, well-known concept, and it's simpler that way, and you can execute that way, and you can have success that way. Also, when you'll know other traders are following that powerful and well-known concept, so they're getting out too as well. Again, trying to, let's say in the case of a sell rule, they're getting out because the trend line's broken, so it's pushing more downward pressure because they're following the core rule around that, and they're not using a filter. So that's one way, that's a very strong argument. Another argument would be that each security should, in theory, have its own filters applied to, as one size does not fit all, right? Each security is its own kind of entity. Thus, you'd have to juggle many different amount and duration filters to trend lines to really make it work or be fair application of it. And that's hard to apply and track, right? If you're tracking whatever, pick a number, 10 different securities just to pick a number, and each one has its own filter, and some are duration filters, and some are time filter or percentage filters or time filters, whatever it might be. That's a lot to juggle around that. It makes it hard to stick to your disciplined predetermined rule. So that's a good argument too as well. Though I think with a lot of securities there's more commonality than that, but there is a good point that each one certainly is its own entity, and you have to be wary of that. But as you apply and you learn your filters, you can kind of overcome that argument a little bit. But that first one, that the breakout principle is powerful, that's a very strong argument. So here's a strategy you can use. You don't have to use it as a filter strategy. And again, you can always fall back to the core, 4 core rules around that. They're core rules for a reason, so think of it that way. But if you like the idea of trying to use filters or other ways to modify to kind of not, if you've been getting frustrated with maybe getting out too soon when it's actually more of a stronger trend and maybe using other indicators to help you, you can use these filters and these other types of strategies to try to manage your way through the most vexing problem in technical analysis, which is false breakouts, for sure. I'd like to leave you with some final thoughts around trend lines. They're obviously a very important and core part, and many people just trade around trend lines. So let's wrap up with a little bit of some final thoughts around trend lines. First off, it may seem a little complex at first, like when do I start, when do I end? Again, you just extend out that line, but starting, picking, it's a little bit more dynamic of a process, and you understand it will get easier with practice, right? And you'll start seeing it, it'll start making sense, and you'll be fine. So it'll get easier with practice. And the trend lines are an indicator. They're a tool, just like there are other indicators out there as you're learning in the course. And so you can choose the indicators that you want to use, right? So you can always do that. And there's an indicator, the trend line, and trend lines are trying to show you, is there an established trend, and is that established trend upward or is that established trend downward? And so that's the whole idea of it, right? And it's great to combine with other trading indicators. So if you have an upward trend, you can use another indicator like a moving average, crossover, Bollinger Bands, lots of different indicators out there that we're going to learn about. You can, or candlestick patterns, for example, and then you can use that with other trading indicators, and that'll help give you further confirmation and confidence in your trades, and also confirmation that you've drawn the trends correctly, and it's all making sense and working out and being as predictable as anything can be. And that's the idea of a trend line, is they're a very strong, indicator around that, because you want to trade off trends, because that's much more predictable than kind of just guessing out there, right? So if there is no trend, if there's no indication of a trend, there is no trading opportunity. You don't have that prediction ability without some type of trend, either up or down, to see what might be happening next. That's where the phrase, the trend is your friend, comes from, because it helps you with that prediction aspect, and then helps you to manage your trades and make decisions based on that technical analysis and logic versus, other ways people might make trades, the weather, whatever it might be. So you're trading on trends means you're not always in the market on all the securities you follow. You might be following a basket of securities. You might be in the market, or you've got a trade out there in some, and others are on the sidelines waiting for some type of trend that you want to trade to develop. So that's where you're in and out in different securities and at different times, with the whole goal of making profit as you use all these indicators and building up to a total profit, and success is the idea. But trends are something that you need to develop too, and you need to make sure and firmly establish that a trend has developed. If anything, where people may struggle is they try to jump in too early on a trend without waiting even at least for a second touch that the trend is established, let alone maybe a third touch that might be much more confirming. So you have to be patient with trend lines, right? So you have to let that trend develop. Once it develops, then that's good. You want to make sure that trend line develop. And another thing that people can struggle with is that they try to make the trend line fit. They really want to buy security. They think it's going to go good and it's starting to look good, and they really want to get in there. But if the trend isn't established yet, then you're at much more risk, right? Then you're not trading on a trend. You're much more risky. And so trend lines help take out some of that risk. It's also very dispassionate. You're not based on hoping. You're based on math, statistics, and logic and things like that to show and also that herd mentality and trading mentality, where lots of people are buying in. They're seeing a trend. They're helping reinforce the trend. You're seeing it too, and you're getting in at the appropriate point, and then you're making your profits as well by trading with these trends, is the idea, in a dispassionate way. Another thing, as far as a final thought, and this I think is real important, is you don't have to be perfect, right? You don't have to be in your trend line drawing. You want to be good. You want to keep getting better all the time, but don't beat yourself up like, I thought there was a trend, because sometimes it looks like a trend ends up not being a trend. Things that look like a breakout are just a false breakout, and this is just reality of trading life. There's winners and there's losers in your trades. That's all okay. It's a whole process, like what we're learning in the course, and we're going to learn about how to manage your investments too as part of this too. So it all goes together. So you don't have to be perfect, let's say, in your trend drawing, and you don't have to be perfect in your trades. You're going to win some, you're going to lose some. And it's hard to get in perfectly at the bottom and perfectly at the top, right? I'm going to say hard. Let's say it's impossible to do that consistently. But the idea is you're getting in close enough towards the bottom and close enough to the top that you're making that profit in between, and you're using your trend lines to help you do that. In fact, a really good quote around that idea is, this from Bernard Baruch, which was, "I'm willing to let others have the first third of a move, and the last third of a move, I want to be in the middle third." All right, so look at our image here, right? We're not trying to buy at 0 or the number 1 touch of, let's say, an upward trend line. We're buying at number 2 or 3, and then we're not trying to, sell exactly at 5, 6, or 7, or even right at 4 necessarily. We're trying to, sell close enough that we make a good profit in there. So the idea of that is we're trying to say is be patient. Let the trend develop. Reduce that risk by letting the trend develop. Don't buy into something you think you see at touch number 1. That's not a trend yet. Number 2 or 3 is a much better indicator. So you're reducing that risk. Be happy with all the profits in that bulky middle third, right? The profits between number 2 and number 4 are great, or number 3 and number 4 are great. And you're doing that over and over again. That's going to be very profitable for you. So don't worry if you thought, I got in too late or I got in too early. Enjoy that middle third. And then, it's kind of that idea of the trend is your friend. You need to have that trend established, so it'll be friendly to you and be really real profitably for you as well. So there you have it with trend lines. I hope you enjoyed this section, and start practicing. And the more you draw trend lines and more you use your trading platform to draw the lines, and you experiment with different stocks, use that paper trading to practice and see, how well you're analyzing things without real money. Use the paper trading to help with that, and using fake money type accounts. That'll be real helpful for you, because you're going to start developing that skill, and you're going to start seeing these trend lines. And you'll start to see them easier and better. And then you should start overlaying other indicators on top of that, like chart patterns or candlesticks or moving averages or relative strength index, all these different indicators. Now you're really coming together as a strong trader, and that's my hope for you. So with that, trend lines, and remember, what are we going to say like the 100th time? The trend is your friend.